Do you want to get rich? Well, for that, keeping the money under your mattress won't work. You will have to invest it and purchase some assets, and then you will see your money grow without any red mark. Well, in this video, we will be telling you the 9 best assets that will make you rich. Now let's start. 1. Dividend stocks. Securities that provide dividends on a regular basis are known as dividend stocks. You may choose to receive your dividends in cash or stock. So let's say a company's stock price stays at $20 per share all year and it pays a 5% dividend yield. In this scenario, a shareholder who owns 100 shares may choose between a $1 cash payout per share or the reinvestment of that money into the purchase of 5 new shares. Stocks that pay out a dividend periodically are a fantastic way to see your money grow. Stocks should not be chosen only based on their dividend yield. It's also wise to consider their P/E ratio, P/B ratio, D/E ratio, and P/G ratio, price/earnings to growth. 2. Exchange-traded funds. Investing in stocks requires purchasing shares individually, which is a time-consuming, dangerous, and costly endeavor. Alternatively, purchasing money is a risk-free strategy. When you invest in an ETF, for instance, you have exposure to a wide range of equities all in one place. Exchange-traded funds, ETFs, follow a wide range of indices, equities, and commodities. There are many different kinds of exchange-traded funds, such as those focused on the healthcare industry, the telecommunications industry, the construction industry, various currencies, and stocks. The $VTI ETF from Vanguard is one example of an exchange-traded fund that tracks an index. Exchange-traded funds, ETFs, are available for purchase and sale via various stockbrokers. There is a day-to-day fluctuation in their pricing. When it comes to rebalancing their holdings, most ETFs take a hands-off approach and instead rely on a system of passive management. Although most of them are automated, others are actively controlled. 3. Investing in index funds. Index funds are unconcerned about their managers and just follow predetermined metrics. In contrast to index funds, exchange-traded funds are traded at the close of trading each day. Index funds are a kind of mutual fund that is known for its cheap expenses and high potential for long-term growth. If you want to know the best earning tricks, then do subscribe our channel and also press the like button. 4. A mutual fund. When investing in a mutual fund, however, you can expect your money to be actively managed or constantly rebalanced by the fund managers. Mutual funds aim to outperform the market, while index and ETF funds aim to replicate its performance. Unfortunately, this approach isn't always fruitful. In addition, the fund management demands a portion of the profits, hence mutual funds often have higher fees. Consider the cost ratio, which reveals the proportion of the mutual fund that is allocated to growth, before making a purchase. 5. Certificates of deposit, CDs. Savings account interest rates tend to drop precipitously whenever the Federal Reserve reduces its rates, which is one of the most unpleasant aspects of saving money. Bank clients, on the other hand, may get longer-term, higher interest rates via CDs. A 6-month CD with an annual percentage yield of 3.8%, for instance, is a real possibility. With CDs, you lock up your cash for a certain length of time and get a greater interest rate in exchange. Your funds will be unavailable until the period expires, which is a drawback. While it is possible to withdraw the funds and terminate the agreement, doing so may result in significant fines and the loss of any accrued interest. 6. Annuities. Insurance firms and banks both provide a product called an annuity to their customers. It is often utilized as a retirement income strategy because of its ability to offer a stable flow of funds over time. Some examples of annuities include the immediate annuity, the deferred annuity, the fixed annuity, the variable annuity, and the indexed annuity. Annuities contain a variety of complexities as well as benefits and drawbacks. They might be a stable source of income, provide tax breaks, and give you a lot of leeway, but they also could cost you money, have little liquidity, and fail to keep up with inflation. If you're considering an annuity as a means to achieve your financial objectives, it's vital that you first have a complete understanding of the product's terms, costs, and dangers. 7. Bonds. An example of a debt security is a bond. Investors in bonds get interest payments on a regular basis and the bond's face value back when it matures in exchange for giving the issuing government, municipality, or company money. Government bonds, municipal bonds, and corporate bonds are just a few examples of the many different kinds of bonds that may be issued by different levels of government and private businesses. The potential reward and risk associated with each variation varies. When a bond reaches its maturity date, the bondholder receives back their initial investment. A few years to many decades is possible. At maturity, the bondholder will get the face value, sometimes called the par value, of the bond. Usually, each bond will cost you $1,000. 8. Real estate assets. Possessions of land, buildings, or dwelling units that may be owned, leased, or otherwise transacted with are all examples of real estate properties. For many people, the twin benefits of capital appreciation and rental income make them an attractive investment option. In the long run, real estate may be a good investment. Rental revenue is one reason why some investors buy property, while others anticipate future price increases as a means to profit. In the real estate market, location is paramount. Location is a major factor in determining property value because of the effect it has on conveniences like shopping, schools, and transit, as well as the local economy. Investment money is often required when purchasing property. Since many people use mortgages and other forms of debt financing to purchase property, interest rates and repayment periods are crucial factors to think about. 9. Bank savings plans. The current climate of historically low interest rates makes the concept of investing in a savings account backed by the Federal Deposit Insurance Corporation, FDIC, seem nearly absurd. The best rates available at the time of publication range from 3% to 4% annual percentage yield, APY, which is excellent. It's also embarrassing that the lowest interest rates available now are below 0.05% APY. High-yield savings accounts, HYSAs, provide greater interest rates than traditional savings accounts but may still only generate a negligible amount of money over time. A HYSA with a 0.4% APY, for instance, would provide around $100 in interest per year on a deposit of $25,000. Providing the interest rate remains unchanged at 0.4% and no further contributions are made, that is. U.S. savings accounts have restrictions on how often you may make withdrawals. There is a monthly limit of 6 withdrawals or transfers for banking clients under Regulation D. That's all for today. Now you know all the assets that could make you rich. We have also told you the strategies you may use to make more money with these assets. Now it's your task to do the research and find out what works for you. Always manage your risk and diversify your money in many assets so that you may earn money even when one or two of the assets start giving you a loss. Sir Warren Buffett and many other millionaires have invested their money, and now they are just relaxing and make lots of money without any task. Sir Robert Kiyosaki is a great lover of real estate. He purchased real estate by taking loans from the U.S. banks. To know more amazing tricks and financial facts, just do subscribe our channel and also press the like button. Comment below if you are having any questions in mind. Share this video with all of your friends. Thanks for watching.